Hello, everyone. I'm Matt with Fundamental Investing Institute. Welcome to today's Fundamentals Unfiltered. We are recording this on Tuesday, December 9th, 2025. And on today's show, we're going to discuss the drama, the takeover battle of Warner Brothers Discovery, and we are going to discuss the future of Berkshire Hathaway. There's a major event that happened there. So I'm sure everyone in the last few days has seen what's going on with Warner Brothers Discovery. I want to break that down a little bit. One of the things that really interested me, I love a good takeover battle and following it and seeing if there's any. Mostly I'm a long-term investor, but these little, what we call special situations or workouts are always very interesting. Sometimes there's some money that could be made. They're usually not spectacular, but it's a great way to supplement a long-term portfolio. And so I follow these with great interest and occasionally take a position. But reading through all this, it reminded me a lot of the RJR Nabisco takeover in the 1980s. And if anyone has read about that, they'll know that essentially RJR Nabisco was a conglomerate that really never should have been, because it was combining tobacco with the Nabisco bakery business. Didn't really make a ton of sense, but nevertheless, that's how a lot of deals were back then. And in the late 80s, there was a management buyout that ended up in a bidding war, and the whole thing sort of there was a lot of intrigue. There were some really interesting characters. There was a buyout guy named Ted Forsman, who's probably my favorite character in that whole drama. But there was a book based on it called Barbarians at the Gate, written by a guy named Bryan Burrough, and then that book was later made into a HBO movie starring James Garner, which was very good. But the whole thing was, sometimes history, sometimes real life is stranger than fiction, and sometimes good historical dramas just happen. And that was certainly one of them. So paying attention to this Warner Brothers Discovery takeover or attempted takeover sort of reminded me of that a little bit. So here's the background. On Friday, this is December 5th, Netflix announced that it was in agreement with the board of Warner Brothers Discovery to buy the studio and streaming business. So just kind of the major component of the business and really the most profitable, but it was going to acquire that part of the business. The buyout value was $72 billion. The terms of the offer: cash and stock transaction, $27.75 per Warner Brothers Discovery share. And Warner Brothers Discovery was planning on separating the studio and streaming business from the cable business, and they're still planning on doing that. So essentially, if you are a Warner Brothers Discovery shareholder under the Netflix deal, what you're going to get, if you're a shareholder today, what you're going to get if this deal closes is you would get the $27.75 of cash and some Netflix stock, and then you would end up getting some shares in this spun off cable business. Now, it's important to know that with the cable business, what Warner Brothers Discovery is looking to do is they're looking to kind of put all the company debt on this spun off cable business. This is actually very common with a lot of these spin-off transactions where one business kind of gets saddled with the debt. And what you end up with is what investors often call an equity stub. And it's called a stub because the equity is such a small portion of the overall value of the company because of the high level of debt. So you end up getting something with a lot of risk because of the leverage. But with these equity stubs, the returns can be very good because obviously leverage works both ways, and if it goes in your favor, you can do very well. Warner Brothers Discovery is valuing that package. So the equity stub that you would get from the spinoff, the cash and stock that you would get from the Netflix buyout, they're valuing that between $31 and $32 per share. So as of this morning, when I checked the price, it was Warner Brothers Netflix stock was trading around 28. Now, this deal is going to take a long time to close, if it closes at all, because there's potentially a lot of antitrust issues, both in the United States and in Europe and other parts of the world, given its global nature. These antitrust issues always happen with what's called a strategic merger, because whenever you have two companies that are coming together, obviously their market share is going to be bigger together than they would separately. And so in some cases, the size of the market isn't really a big deal. But in this case, if you're just looking at streaming, the combined market share of Netflix and the Warner Brothers, I guess it's HBO Max, which is their streaming business, ends up being about 30%, which is pretty much the antitrust threshold. So what Netflix is trying to argue is that that's really a flawed definition of market and market share. They're sort of saying that, well, you need to consider all these other things, YouTube and gaming and everything that people watch, as part of the market. So that side of it always comes down to how you define the market. And Netflix is confident that they can get that done, as evidenced by they agreed that if the deal falls apart for antitrust issues or other kind of regulatory issues, they've actually agreed to an almost $6 billion payout to Warner Brothers Discovery. So I think that's showing that they have a pretty high level of confidence that they would be able to get this through. Now, on Monday, yesterday, December 8th, Paramount comes along and they offered $30 a share for the entire business, right? No split off. They said, we'll take the entire business, $30 a share. This is the streaming, the cable, and the studio. And there's a little bit of a background there, which I'll get into, but the Paramount deal, Paramount's much smaller than Netflix. Netflix has an over $400 billion market cap, and Paramount has like a, I don't know, $16 or $17 billion market. Paramount Skydance, which is the parent company, I think has about a $16 or $17 billion market cap. So it's much smaller than Netflix, but it's controlled by the Ellison family. The Ellison family, Larry Ellison is one of the founders of Oracle, one of the wealthiest families in the world. They're also bringing in some equity partners with some investment funds, sovereign wealth funds. I think Jared Kushner is in the deal. So they have equity partners. I don't think financing is a problem on either the Netflix offer or the Paramount offer. So they're offering $30 billion all cash. There's no stock involved. So there's going to be some argument as to whether this is a more advantageous deal than the Netflix deal. But it's also a hostile deal. And it's hostile in the sense that management is not endorsing it. And what they're doing is they're structuring it as a tender offer, which means they go directly to the shareholders. They give the shareholders a period where the shareholders can agree to tender, which means sell their shares at a fixed price, in this case $30 a share. And I think the shareholders have until January 8th, although my understanding is that Paramount can extend that. Now, the way all this works is that Warner Brothers Discovery will have until December 22nd to review Paramount's hostile offer, determine if it is more valuable than the Netflix offer. So what Paramount is arguing is that it's more valuable because A, it's a cash offer, and B, they should have less regulatory hurdle. Now, this is getting very political too, because the president weighed in, and of course the president is close with the Ellison family. Jared Kushner is the president's son-in-law, so it's unclear whether there's going to be a huge political aspect to this, but nevertheless, that's playing out. So the financing is in place, both deals. That's not the problem. But there's a backstory here to Paramount that is interesting, and that is the Ellison family has been courting the CEO of Warner Brothers Discovery, a guy named David Zaslav. They've been courting him since, I think, late summer or so, and Paramount has already made 6 offers, and they kept getting spurned or dragged along. So now it's kind of pretty obvious that the Paramount offer was used as what's called a stalking horse bid, that just opened up the bidding process to other buyers for whatever reason. Maybe David Zaslav didn't want Paramount to be the buyer, but that opened up discussions with Netflix, and it led to the Netflix offer, which came about last Friday. But because you have this history, and there was some reporting that, David Ellison, Larry Ellison's son, is the head of Paramount Skydance, had personally dined with David Zaslav at Zaslav's home, and Larry Ellison had met with him. I don't know if it was in person, but they had been courting him for a long time. So there is a little bit of this kind of personal beef, which is always interesting, because what you're starting to see play out is basically you're probably going to have a bidding war between Paramount and Netflix. The Paramount offer did not, and they made a point to highlight this, the Paramount offer did not include the language of best bid, right? So that's very important, because it kind of opens up the door to a higher bid down the road. And so the board has until December 22nd to review it. If they do determine that the Paramount bid is the superior bid, they can then go to Netflix and give Netflix, I think, 4 days to counter the offer. So this thing is in play. And to go back, if you're a Warner Brothers shareholder, the Netflix deal, they were saying that it would take 12 to 18 months because of all of the antitrust issues that they got to go through. A Paramount deal could probably take a little bit less of that, simply because there's less market share involved. But in any event, that's not a huge deal spread. I mean, if it's $31, $32 a share, you're looking at about a $3 deal spread, $4 deal spread on the Netflix deal. That would take 12 to 18 months to play out. So there's not a great return there. Even lower deal spread on the Paramount deal. And again, a little bit less time, but nevertheless, I think anyone's holding on to this stock is probably doing so in the hope that you get higher offers from both Paramount and Netflix. So it's an interesting drama. There was an article that made the case that it sounded like an episode of Succession. I saw a couple episodes of that show, and it probably could. There's definitely some interesting drama, and it's going to be interesting to see how this plays out. But there's going to be more. There's going to be more involved. My educated guess, and I'm pretty confident saying this, is there's going to be higher offers from both Netflix and Paramount, and we'll see how this plays out. And like I said, it could get definitely political. Another big news this week that came out, if it was yesterday or the end of last week, Berkshire Hathaway announced some high-level personnel changes. The biggest bombshell was that Todd Combs, who's one of the 2 money managers that Buffett had hired in the past decade and a half, I guess, to help oversee the portfolio, he's now leaving and going to JP Morgan. Now, Todd Combs was hired in 2010, and then, I don't know, a year or two after, Buffett and Munger hired another money manager named Ted Wischler. With Todd Combs and Ted Wischler, I think they were given collectively 20 or 30 billion to manage, and by every indication, they did a pretty good job doing that. Now, Todd Combs had an insurance background, so a couple of years ago, he was given the responsibility to oversee Geico, and he was very central to bringing Geico into more of a data analysis company, which is something that Progressive had done very well. So he'd overseen this big change at Geico. I don't know if he was positioning. A lot of people thought he was going to oversee the entire insurance unit, which right now Berkshire's insurance unit is overseen by Ajit Jain, but Jain is in his 70s, probably stepping down. So what this big announcement is doing is, I think it's raising a lot of questions about whether Greg Abel is coming in and shaking things up a little bit behind the scenes. And just to comment a little bit on that. Now, there were some other changes that Berkshire announced. One is their longtime CFO, Mark Hamburg. He's retiring, so they're going to have somebody else in that position. They named a guy named Michael O'Sullivan. He's going to come in as general counsel. He's been working with Snap, but he's also a former partner at the law firm that Charlie Munger had founded. So he's someone who had some links. I don't think Berkshire had the position of general counsel, so this is something that they're creating as part of the post-Buffett handoff. And then, of course, with Combs stepping down, not only are they losing him as a money manager, but it's leaving a opening at Geico. So a woman named Nancy Pierce, who I think has been the chief operating officer, she's going to step into the role as the CEO of Geico. So, but definitely the biggest part of that would be Todd Combs stepping down, and it's raising kind of the questions about how the Berkshire investments are going to be overseen, what kind of CEO Abel is going to be. Now, you have to keep in mind that Abel he's not a chairman CEO, and that's very important that Berkshire is maintaining the separation of chairman and CEO, unlike a lot of other companies. So Abel is not quite able to come in and put his mark in the company the way that you might see in some other company. I've seen a lot of companies over the years where what'll happen is you have a family founder, and then they'll transition to somebody outside of the family, and then there's just huge changes that are very often unnecessary. It's just kind of the CEO putting their own take on the company and trying to leave their own legacy, and it's not necessarily in the best interest of the shareholders. I don't think that's what's happening here. I don't think Abel is necessarily at the root of a lot of these changes, but Combs is leaving. He's going to JP Morgan, and what he's doing is JP Morgan a few months ago announced that they're going to be putting up to $1.5 trillion, most of that in their lending, but they're going to be doing this around domestic companies that are focused on national security. So Combs is coming in, and he's going to be overseeing about $10 billion of their equity allocation towards that. And of course, it does raise questions as to why he's leaving. A lot of people thought, like I said, that he would be overseeing the insurance units, and some people thought he was going to be taking over for Buffett himself. But it does raise questions as to whether Greg Abel is going to be overseeing all of the capital allocation himself. He doesn't really have an investment background. He's more of an operator. So it does raise a lot of questions. I'm a Berkshire Hathaway shareholder, so I am a little bit interested to see what happens when there's a full transfer of authority to Abel and what things are going to look like. Ted Wischler is still there. We don't know for how long, but Combs stepping down is a huge knock for Berkshire Hathaway. So we'll see how that plays out. I also I talked a little bit about this book last week, but it wasn't quite a book recommendation. I talked about this because I am putting together a stock investing course. I'm doing a big section on kind of the history and the evolution of the U.S. stock market. And this is one of the books that I was relying on. I talked about it last week because in chapter 4, the author, Bob Pisani, who's a journalist on the floor of the New York Stock Exchange, chapter 4, he gives he talks about his friendship with the head of floor operations. His name was Art Cashin, and Cashin had died about a year ago. And I wanted to talk a little bit about Art Cashin, but I didn't talk much about the book. So I finished the book over the weekend, and I do want to give a recommendation because it is a great overview of kind of a lot of what he had learned being in the stock market for so long. It's a great, my purpose for reading it was to get his take on how the stock exchange had changed so much, because of course it was largely in-person trading, and then it transitions over to electronic trading, and that was a hugely disruptive thing. So he gives a first-hand view of that whole process. My only gripe, and it's a relatively small one, is he mentions he gets a date wrong. He mentions going to Cuba in 2008. It's a very interesting story, but he mentions that it correlated with a visit by Pope John Paul II. But he gives the year as 2008. Of course, Pope John Paul II had died in 2005, so he was either getting the year wrong or the Pope wrong. But he also mentions that it was around the time of the Clinton-Lewinsky scandal, so that gave it away. And I did look it up. So that trip was from '98, and he mentions it as 2008. So that's my only real gripe. But he talks a lot about the evolution of his thought and being in markets, and he became a very big believer in indexing, using index funds rather than actively traded funds. He talks a little bit about exchange traded funds and how they came to become such a big part of the market. So it's a great read for anyone who is interested in the modern history of U.S. markets, along with some history of financial journalism and just some general 20th century history. The book is called Shut Up and Keep Talking, and it is it's really a treasure for anyone who's interested in the New York Stock Exchange and in stocks in general. With that, hope everyone has a great week. As always, focus on the fundamentals, and we'll see you next time.